Welcome back. We interrupt the news coverage to get you the special macroeconomic coverage. The all-important fourth quarter GDP and GVA numbers are due. Ekta Batra, my colleague, is also with me. Ekta Batra had, of course, polled a lot of economists, and her poll expectation is that it would be a 7.3% GVA growth for the fourth quarter and 7.6 GDP growth. But Ekta, with your permission, let me invite first our first guest to this discussion. Before we get into the GDP numbers, we got the core sector number at 8.5% for April. I'm joined by Dr. Pronab, the former chief statistician and currently chairman of the Statistics Commission. Dr. Sen, 8.5% core sector growth. Should it make us extra happy? I've not seen an 8.5% in a long time, but it also comes on a minus 0.2% in the previous April.
That's about right. If you really correct for the base effect, what you're getting is a core sector growth of about 4.5, 4.7. And that's roughly consistent with a 7.5% GDP growth. Okay.
We also got a very good electricity number of 14.7%, almost 15%. Should that be something we should be cheerful about? Coal has not done well, but that we knew. We knew from the Coal India numbers that there is a lot of unsold inventory, and so coal was always expected to come negative. It's come negative 1%. But electricity, 14.7, is that very good news?
Latha, up north here, we are sweltering at 48 degrees. Of course we're consuming electricity. Okay. It's not good news for us. Okay. Maybe good news for the GDP, but we are suffering.
Okay, but the nation is able to afford to consume 14.7%. I'm just asking, as a macroeconomics observer, should that be seen as one more point towards growth or par for the course?
No, we don't know. On that, at the end of the day, the affordability issue really boils down to the solvency of the state electricity boards. I think the chickens will come home to roost a little later, once the power companies send their bills to the electricity boards.
Okay. Dr. Sen, what is that? What does this particular core sector data tell you more about growth in FY17? Because we are due for the Q4 GDP figures as well, but that would be more backward looking. Plus, we've got high frequency data such as auto sales, which is indicating growth, cement dispatches, etc. So is FY17 going to be a better than expected industries as well as GDP growth overall, according to you?
The core sector data one has to treat a little carefully, because most of the sectors are not actually demand driven, they're supply driven. And in a sense, if we've been tracking the investment figures properly, the core sector data should be pretty much predictable.
Okay. Just going by the other data that we have got, as Ekta was saying, the very good cement dispatches that we got for the Jan-March quarter, as well, the later auto sales numbers that we got even for April, which looked good. Commercial vehicles looked very good. Two-wheelers looked excellent for companies like Bajaj. Should we assume that FY17 is poised to be much better than FY16?
Well, the efforts that the government has been making in reviving infrastructure investments appear to be paying off. Cement dispatches, I think, really reflects what's happening in the road sector, because so far as I can make out, the real estate sector isn't doing anything very much. So I think it's just reflecting something we've been waiting for a little over a year.
Okay. Well, we are still awaiting the numbers. What's your sense? The second FY17 could be a good 0.5%, 50 basis points faster GVA than FY16, sir?
It could, but I'm always amazed at how precise our economists are when they say 7.3. I would be very hesitant to put it in a range, but yeah, I think it will be better, and a lot of what you're seeing in terms of consumption, which is at the moment This is really reflecting the expectations of the monsoons.
Okay.
So there, there's an expectation that things will pick up, but that should not get reflected in the fourth quarter of last year's estimates.
Okay. We have Mr. Samiran Chakraborty, Chief Economist at Citibank, joining into this conversation as well. Samiran, hi. Thank you very much for taking the time out this evening. First, your thoughts on the core sector growth. Do you think that that's just going to override any sort of industry growth that we get this time round from the GDP? And I think we might have got it. 7.9%. Wow.
Okay, this looks very good. This is the GDP number though, and that, according to our poll, was expected to come in at 7.6%, coming in at 7.9%. As always, we're not getting too much. Our PIB website doesn't oblige very easily, but we'll read out the numbers off the screen. So if the fourth quarter GDP is 7.9, then the full year GDP number should be better than what the annual forecast was. I think our annual forecast had come in at 7.3 GVA and 7.6 GDP. So perhaps there is a slightly upward revision there. Dr. Sen, first thoughts, Q4 GDP coming in at 7.9 instead of 7.6.
And Latha, for the year, then the average works out to 7.625.
Okay, so that's marginally better. Again, Dr. Sen is going to laugh at the precision, at the preciseness. But Dr. Sen, better than expected numbers, you would say?
Oh yes, certainly. I would have been quite happy with 7.6.
Okay. Well, Samiran, first thoughts on just this number that we have, 7.9% GDP versus our poll of 7.6, and therefore the full year GDP coming in at 7.625.
Well, Latha, we were expecting a higher number. We were at 7.8, so it's pretty close to what we were anticipating. The crucial element was the agricultural GDP number. My sense is the number has been good, plus the manufacturing side, the GVA of the reported company results must have been very good. So both these factors put together must be driving this number higher. So in any case, the January-March quarter has been a better quarter in terms of activity.
I've just got a few more numbers.
GDP is just reflecting that.
I've just got a few more numbers, Samiran. The Q4 number at constant prices is 7.9%. At current prices is 10.4%. Now, it looks like the deflator has not grown so much. If you remember, in the third quarter, it was 7.2 and 9.1. So there was a 200 basis point difference. Now there is only a 50 basis point difference between the constant price and the current price, coming in at 10.4%. So I think the GDP deflator is a little lower. I will leave you all to calculate that. Let me just come to the finer numbers. Agriculture has come in at 1.2%. That compares with 0.2%. We'll try and get you the previous comparisons as well.
Yeah.
But let me just rattle out the numbers. Agriculture coming in at 1.2%, mining and quarrying coming in at 7.4%, manufacturing 9.3%, electricity, gas, water supply, other utilities at 6.6%, lower than the 8% of the previous year. Construction has come in at 3.9, again lower than the 4.4 of the previous year. This far, manufacturing has been the best performer with 9.3% compared to 5.5% year ago. I'm giving you the full year numbers at this point in time. Actually, the full year average has come at 7.2 Ekta. So full year number, something has been revised earlier. So FY16 full year GVA has come in at 7.2%. Trade hotels has come in at 3.9, so that's a rather bad performance compared to 4.4. What else do we have? No, I'm sorry. Construction came in at 3.9. Trade hotels has come in at 9% compared to 9.8. Finance real estate is at 10.3% compared to 10.6. And public administration has done the worst, coming in at 6.6% compared to 10.7%. On the whole, FY16 is done just 10 basis points better at 7.2% GVA growth compared to 7.1% in the previous year. That is GVA. at basic prices.
The GDP for Q2 has in fact been revised lower by a notch. So it's 7.6 versus 7.7% earlier.
Okay.
So it comes to an exact calculation of 7.6% for the entire fiscal. And remember that the advanced estimates, which was put out by the government earlier, was at around 7.6%. For the GVA, the advanced estimates was 7.3%. So they've come in at around 7.2%, like you mentioned.
Okay, I just want to a word on the deflator from Samiran and Dr. Sen. In Q3, actually a lot of the numbers have been revised. In Q3, the GVA was 6.9 at constant prices and 7.5 in current prices. Now the GVA in fourth quarter is 7.4% and in current prices it is 8.5. Your thoughts? Is the period of deflation over, Dr. Sen?
No, we knew that prices were turning up, but it's turning up slowly. I think you're going to see more acceleration in the following quarter.
Okay, Samiran, your thoughts?
Inflation.
Yeah, clearly, if you see the CPI number between Q3 and Q4 were pretty much the same. The average CPI, but the average WPI was much higher in Q4 compared to Q3. So we were anyway anticipating that the GDP deflator will be higher in Q4 compared to Q3. In fact, going forward in FY17, if we have to achieve something like a 11% nominal GDP growth, then the GDP deflator has to be significantly positive. So we expect this trend now to settle in FY17 as well.
Okay, well, there are a couple of revisions which have taken place. I think the Q1 GDP has also been revised to 7.5%, if I'm not mistaken, if we can pull that up for you. And Q2 has been revised to 7.6%. We have Q3, which stands at around 7.2%. So the average, we just have to wait by and see what it's coming at on a final average or a final tally. So we'll wait by and just watch out for that. But we have Soumya Ghosh of State Bank of India also, who's joining in to talk about the numbers. Soumya, your first thoughts on the GDP growth, which is coming at 7.9% for this particular quarter, for Q4 of FY16?
See, I think we were expecting some sort of a bump up in the growth rate, but the bottom line is that most of the bump up, if you look into, that is because of the revision in the Q3 numbers. I don't know what's the revision in the Q3 GDP and the GVA numbers. I have a feeling that the Q3 GVA numbers, which are 7.1%, could have been revised downwards further. So that means that the overall GVA growth rate is at 7.2% instead of 7.3%, and there has been a significant bump up in the GDP estimates at 7.9% for Q4, so that the 7.6% growth rate has been achieved. So some sort of a bump up over there, but as Latha was reaching out some of the figures, if I remember it correctly, I think the trade, hotels, transport and communication sector is holding up with a growth rate. I think, I don't know the Q4 growth rate, but Q3 was around 10%, but most of the indicators like the domestic passenger car sales, the two-wheeler sales, the foreign tourist arrivals are now showing some signs of a bump up. The other good thing is that as the core sector data just revealed, there is a bump up in the cement production and also the steel production. So that is going to have a positive impact on the construction sector. So overall, and manufacturing sector, if you look into the GVA number and the CSO GVO number and the corporate sector GVA number, if you just juxtapose them, I think they are more or less in line. So that is one thing. And the other issue is always, I mean, we have a disconnect between the IIP numbers and the GVA numbers, but there's an important trend over here is that if you look into the IIP numbers, which has been trending downwards for the last couple of months, but the net sales of the corporates are in fact going up. So one possibility of that reconciling could be there has been a drawdown of inventories, which is exactly happening in the last couple of months. So overall, the picture looks positive, and hopefully the next year GDP number could be a higher end of the government estimates of 7.1 to 7.75%.
Okay, well, I've got some numbers of the private final consumption. It looks like private final consumption is up and away. Private final consumption has grown at 8%, 8.2% to be precise, while gross fixed capital formation has actually degrown. It's a contraction of 1.9%. Government final expenditure has grown by just 2.7%. All these are fourth quarter numbers. I'll just reiterate it for you. The private consumption is the best, growing at 8.2% in constant terms for fourth quarter. The government consumption growing only by 2.7% and gross fixed capital formation minus 1.9%. Any thoughts, Soumya?
The growth rate of private consumption at 8% for the last quarter is a matter of great satisfaction. So that means we are actually seeing some sort of consumer demand reviving in the last quarters. And I think if you remember in the March month also, there has been a significant jump up in some of the sales of the passenger cars and others. So there is a significant jump up. So that's one positive thing. And regarding the investment demand, I am not amused at all the degrowth in the last quarter, because as of now the investment demand is showing little signs of revival, and only a capital expenditure push on the part of the government in sectors such as railways could help bump up the investment, but that will take some amount of time.
Okay. Also for the full year, that is the calculated number which we have. The private final, again, not a very good performance as far as capital formation is concerned. Capital formation has fallen even on a full year basis. Okay, I just missed that. Okay, here's the private final consumption for the full year has grown by 12.3%. Okay, that's current prices, I'm sorry. Let me come to the constant prices at 2010-11 prices. Private final consumption has grown by 7.4%, government final expenditure by 2.2%, and GFCF, gross fixed capital formation, has grown by 3.9%. Exports expectedly have fallen by 5.2%. Dr. Sen, your thoughts? Gross fixed capital formation on a quarterly basis has fallen. On an annual basis, up 3.9%, but private expenditure, very good, 7.4% for the full year and 8.2% for fourth quarter.
Well, Latha, as a macroeconomist, what I would ideally like to see is private final consumption expenditure growing at roughly the same rate as the GDP. Anything very much in excess of it is worrisome, because what it essentially means is that your savings are being contracted. Now, why this is happening, I don't know, but one of the things that we do know is that this year the dividend payouts by the companies has been at an all-time high, and that may be happening. So what's essentially happening is that corporates, instead of using their profits to grow their investments, are essentially paying out dividends and helping grow consumption.
Okay. Well, Samiran, your thoughts on the same thing? On an annual basis, capital formation is 3.9%. For the fourth quarter, it is minus 1.9%. Likewise, private final consumption expenditure, which is really the big part in the demand side, growing by 8.2% for the fourth quarter. But for the full year, and I think, what, 7.4 did I say? Or 7. Yes, 7.4%. Your thoughts, Samiran?
Yeah, the kind of a decline in growth rate in GFCF is something which is surprising me, because even when the government had given the advance estimate of GDP 3 months back, the full year GFCF growth was expected at 5.6%. So compared to that, this 3.9% number is significantly lower. And given whatever investment indicators we were tracking from steel, cement, etc., electricity, it didn't look like that the fourth quarter would actually be a negative number on GFCF. So we need to check a bit that exactly what component of GFCF declined in this quarter. But overall, if you see, the broad story remains what we have been saying for a while, that even FY17, the growth will be driven more by consumption rather than by investment. One just hopes that that leads to a correction in the capacity utilization number higher rather than a higher inflation.
Well, what stands out is also the industries with construction. So if you look at it, added to that, it's up around 7.9% on a year-on-year basis. We did around 9% in the previous quarter, so it's come off on a Q-on-Q basis, but nonetheless, it's better than the 5.7% that we did in the same quarter last year. Samiran, if you just had to go through the constituents of industry with construction, mining up 8.6%, manufacturing up 9.3%, albeit it's come off from the 12% in the previous quarter, electricity up 9% construction up 4.5%. What does that tell you about industrial growth and maybe manufacturing in terms of roads, etc., going into FY17 as well?
So as you know, in the new GDP series, about 70% of the manufacturing comes from the company's published data, GVA from that, and about 30%, which is so-called unorganized sector, is proxied by the IIP number. So since the IIP number was relatively weaker in Q4, it could have dragged down the overall manufacturing number. But if you just look at the GVA number, we did some calculation on the published results. It appears that the GVA growth from them was quite strong in Q4. And if this trend continues in FY17, then that should be the primary driver of manufacturing growth. So not expecting a big decline there. Hopefully this continues.
Okay. Well, so let us sum it up like this. The overall GVA number for the fourth quarter has come in at 7.4%. compared to 6.2% in the previous quarter. And the overall GDP number has come in only at 7.2%. No, sorry, that was the overall GVA number.
The GVA
the
number.
full year GVA number comes in at 7.2%, but the fourth quarter number comes in at 7.4%. So that doesn't look too bad, especially because it was a low base. The important positive appears to be private final consumption, which is going at 8.2%, and the government consumption growing at actually contracting at minus 1.9% for the fourth quarter. In fact, even if you looked at the public administration, the breakup from the supply side, it is public administration that has done the worst at 6.4%, but other service sectors like trade, hotels, transport and financial services have both grown over 9%, 9.9 and 9.1. Trade hotels at 9.9 and financial services at 9.1%. So overall, it does look like services sector has not done too badly. Most of the minor disappointment in growth appears to come from the government not having spent enough, at least going by both the supply side as well as the demand side numbers. Any thoughts, Dr. Sen?
No, actually, Latha, the government sector in GVA, we expect a growth of somewhere around 6.5.
Okay.
Anything in excess of that really means the government is hiring more, and that may not always be a good idea. And I'm perfectly comfortable if it hangs around 6.5, which is more or less what it's done. 6.4, you said.
Yes.
Okay.
Well, overall, you know, I mean, is there a disappointment that the GVA is only 7.2, Dr. Sen?
No, not at all. I mean, look, what are the numbers telling you? What it's telling you, in effect, is that there's been a sharp contraction in the subsidy payouts.
Okay.
That's the difference between the growth in GDP and the growth in GVA. And that's a good thing. I mean, what it's saying in effect is that your fiscal position is becoming stronger. Hopefully it'll stay that way.
Okay. And a 7.6% GDP number for the full year, is that more or less in line with expectation, or is it even better? Because we did, I think, 7.1.
No, that's about in line with expectations. And, you know, as I said, 0.4% growth in the net indirect taxes is, which is the difference between the GDP growth and the GVA growth, is really net indirect taxes going up, which is good for the fisc.
Okay. Well, actually, there are so many numbers.
It's telling a positive story about the fisc.
Okay, yeah, certainly it does. With subsidies contracting and indirect taxes increasing, it certainly says a positive story about the fisc. Okay, well, there are a bunch of numbers here. If you have to take away in terms of key takeaways, Soumya, we are confusing people with fourth quarter GVA and GDP, with full year GVA and GDP, and we are talking about capital formation and private consumption. That's a whole swelter of numbers. What will be the key takeaways for you, Soumya?
No, I think I agree with Dr. Sen regarding the divergence between the GVA and the GDP. I think last time we had such differences. I think the GVA was less than 7% and GDP was close to 8%. It was, I think, 3 to 4 quarters away. So from that point of view, it's a welcome departure that indicates that the improving fiscal situation of the government. The other good thing from the data is the growth rate in the agricultural. I think the agricultural sector growth rate has actually rebounded, if I am correct, to around more than 2% quarter on quarter. And against all expectations, the Rabi output has been better than the Kharif output. So that is one good thing which has happened. Regarding the service sector, I think the numbers are as in line with the expectations. The transportation sector is holding up, and there are indications that the demand is holding up. The public administration defense sector has not lost a growth rate, and that is in line with the government fiscal consolidation plan. So overall, the numbers are fine. But just a small point I would like to mention caution over here. If we ever just looking through the numbers, and I saw that the GVA of the third quarter, which was at 7.1%, and has been, as expected, has been cut to 6.9%.
Okay.
So that may actually indicates why the last quarter number has been such rosy. So we need to discount that number, but overall numbers are good enough to point towards a slow and steady economic revival.
Okay. Samiran, what would be your key takeaways from all the numbers we have read out? Unless you want us to read out some more numbers, what are your key takeaways from the both fourth quarter and the full year numbers?
I think I want to make 3 points. One is that there was a brief decline in activity in Q3, where both GDP and GVA declined compared to Q2. So that decline seems to be over in the Q4 data. So we have passed through that small trough and now back into the trend line growth. That's point one. Point two is that there seems to be a clear indication now that consumption is the main driver of this economic recovery rather than investment. Although as an economist, we hesitate to applaud that, but we are probably in a situation where we needed a little bit of a demand pickup for capacity utilization rates to improve, and we are seeing early signs of that. And third is that we are seeing that finally the deflators are moving in the right direction, and we hope that this trend continues in the future, where we see a little bit of a higher nominal growth numbers, because ultimately a lot of corporate profitability, etc., is connected to the nominal growth number rather than the real growth numbers. So that improvement in nominal growth is also something I'm watching closely.
Okay.
No, that should definitely make you happy, because the nominal GVA growth for the fourth quarter has come in at 8.5%, and it was the GVA at constant terms is 7.4. So clearly the deflator is something that is working in the right direction, at least.
Samiran, just wanted your thoughts on one particular fact, that what are you projecting for FY17 now that we have the FY16 numbers? 7.6% is what we've closed FY16 with. Your thoughts on FY17, your figure?
So we were looking at 7.7. I don't see an urgent necessity to change that forecast. We're on the right path. Let's not forget that this was the last quarter of a favorable base effect. Last year, the same quarter was in the 6 handle. From now on, all the other quarters would be in the 7 handle. So that positive base effect is not going to support from next quarter onwards.
Okay.
So that's why I'm not going to jump the gun and increase the growth rate forecast right away. Happy with the 7.7 forecast.
Okay, I have two questions. One, Samiran, See, we have two positives also for the current year. I mean, hopefully, of course. It looks like agriculture should be blessed with a better monsoon, going by what the Met is saying. It's not as if we've got a terrible GDP number. I mean, agriculture number, it's come in at 2.3% for the fourth quarter. But nevertheless, if we have a good monsoon, and if exports don't contract, we have a 5.3% annual contraction in exports. And, we have possibly a good monsoon in FY17. Given that exports need not be so bad, it has a lower base, and we are seeing commodity prices doing a little better. So the destination of our exports should be a little better hydrated to buy our goods. Given both these, is there a case for a better GDP performance and a GVA performance for FY17?
Latha, I would agree with your first point, but probably not so much with the second point. Yes, the positive monsoon forecast, it might distort the agricultural growth number quite substantially because of the low base of last 2 years, and that remains kind of a wild card. But on exports, I think you are looking at the exports number, but not the net exports number, which really will go into GDPs. And the net exports have not contracted at all. Okay. In fact, our worry is that in FY17, net exports could become a bit of a headwind, and that's why not so comfortable with that. The element that I want to add is the pay commission impact.
Okay.
We were anticipating that the pay commission itself could add about 30-40 basis points to GDP growth. But if it is delayed any further, then possibly we might not see the full impact in FY17 GDP. Part of it could be spilled into the FY18 GDP numbers.
Okay. Well, Dr. Sen, I wanted to ask you about this per capita number. We've got a per capita GDP number that has not at all grown as fast as last year. We have a per capita GDP number of 7.4. Last year, the comparable number is 9.4%. Is that worrisome?
Are you talking about the nominals?
No, I don't think so.
Because otherwise it doesn't add up. Okay. Because you are talking about...
oh yes, current prices. You're right, sir. You're right. I'm sorry.
So this is the current prices. No.
Yeah, you're right.
You're right.
You're right. You're right. It was current prices that it was lower at 7.4% compared to 9.4%. But in real terms, you're right. And constant prices, per capita GDP has risen from 5.9 to 6.2. So good going there.
Yeah. Well, that's about expected because as I said, that the population growth is pretty much predictable. So you're looking at something like 1.5, 1.6% population growth. So if you're getting 7.6, take it away and you're there.
Okay.
Okay. Dr. Sen, wanted your thoughts on...
No surprise.
Okay.
Wanted your thoughts on how much better we could do with agri in FY17 based on a normal monsoon?
Well, it can be quite dramatic, but one has to be a little careful because we still really don't know how prices will react.
Okay.
And we've had instances earlier where good monsoons have led actually to some rural distress because there's been price collapses.
Okay.
So on the agricultural GDP front, you'll certainly see better numbers. Okay. But whether those will translate into consumption growth is something that we have to be a little cautious about.
Okay. Finally, let's end with some prescription for policy from all of you. Soumya, we have, as we just pointed out, a much better private consumption. For the annual number, it is 7.4. For the fourth quarter, it is 8.2%. And we have, a contracting GF fixed capital formation number. Basically, a lot of, it's largely a private consumption-led number. Do you think this makes life a little difficult for the Reserve Bank to hike rates, to cut rates? One, we have already commodity prices rising. We know that even food prices have risen in the last available data. And now we get that private final consumption, as Dr. Sen pointed out, is a little ahead of GDP growth, GVA growth itself. Is all this making life difficult for the Reserve Bank, Soumya?
No, I don't think so. I think the increase in the private consumption is a matter of actually encouragement because private consumption has been lagging behind, as you have saying in our loan books also in the last couple of quarters. So That is one thing. So I'm not too much concerned about the the consumption part, even though the pickup is encouraging. But the other point which I'd like to mention is regarding the inflation part also. I think as of now, the price rise which has happened in the CPI in the month of April and May, they are a part of the, in April, and they are a part of the normal trends. If you extrapolate to the last 2 to 3 years, you will find that this year price rise has not been as that dramatic as the last couple of years. So from that point of view, hopefully once the monsoon gets in, the prices subside, the inflation trajectory will become much more comfortable. And if that is the case, the RBI should not have much to worry about, apart from some exigencies in the form of some external sector.
All right. Finally, Vivek Rajpal of Nomura is joined us all the way from Singapore on phone. Vivek, well, do all these numbers, I guess you got the gist of 7.6% GDP growth for the full year and 7.9% GDP growth for the fourth quarter itself. Private final consumption doing very well at 8.5% in constant terms, GVA. Putting all this together, as a bond trader, should you worry about anything at all for trading tomorrow?
Not really. I mean, if you really see, markets are pretty range bound. I think as far as the expectations are concerned, market is not expecting any immediate rate cuts. In fact, we are not expecting any further rate cuts. The focus is really on the policy transmission, how much RBI infuses liquidity. And from that perspective, I still expect the range-bound markets to continue in the near term.
Okay, so Vivek, we closed the yield at around 7.47% today. You don't expect much of a movement tomorrow?
No, I mean, I think as far as the number is stronger, and if there are only marginal expectations in terms of any further monetary easing, that may be taken out. So probably we can move a little higher by 1 or 2 basis points. I mean, it's just not the local factor which is currently important. One needs to also realize that with every passing day, we are getting closer to the FOMC meeting as well. So from that perspective, I expect quite a range-bound kind of a market. I think 10-year bond yield will broadly range trade in a 740 to 755 range over the coming couple of months. And this data specifically is not a big trigger to break the range in either side.
Okay. Well, gentlemen, we have to call it a day on this discussion. Thank you very much for joining us with all your thoughts. Well, the important point is that the GDP number has come in as per the advanced taxes expectation. The advance for the full year has come in as per expectation, but the GVA number is a tad lower at 7.2% compared to 7.3%. So that's on the full year. The GVA is a slight disappointment, but the GDP number is exactly as the advance estimates indicated. So largely factored in, the market has nothing to react, but only when it comes to the fourth quarter, the number is much better than what was expected. That's because the government has now depressed the third quarter numbers. So you have a much better fourth quarter number at 7.9% GDP growth. Not much to react perhaps for the markets, since this is a laggard number. That's all we have on this special